Credit cards are everywhere, from flashy metal cards to enticing cashback offers. They promise convenience, rewards, and financial freedom. But behind the polished marketing campaign lies a multi-billion-dollar industry that doesn't just hand out perks out of generosity. So how do credit cards really make money? Let's break down the three main revenue streams: interest, fees, and merchant charges. By far, the largest source of revenue for credit card companies comes from interest payments. This happens when you carry a balance on your credit card month to month. Credit cards often come with very high interest rates, called the annual percentage rate, typically ranging from 15% to over 25%. Some subprime cards go even higher. Let's do the math. Imagine you charge $1,000 on your credit card and only pay the minimum each month. With a 22% APR, you could end up paying several $100s in interest over time. That means you're not just paying for the item, you're paying a premium just for the privilege of delaying your payment. This is what banks count on. They don't expect every user to carry a balance, but they know that a large percentage will. According to the Federal Reserve, about 45% of Americans carry a balance month to month. That means nearly half the population is actively generating interest income for credit card companies. And it adds up. In 2023 alone, Americans paid over $130 billion in credit card interest. That's pure profit for banks and lenders. Fees, the sneaky side hustle. Even if you're one of the financially disciplined people who pay off their full balance every month and never pay a cent of interest, the credit card companies can still make money off you. How? Fees. There are a few common types. Annual fees. Premium cards often charge anywhere from $95 to $695 per year. This fee is justified with perks like airport lounge access or extra rewards, but it's still direct revenue to the company. Late payment fees. If you forget a payment or miss your due date by even a day, you could be hit with a fee up to $40. Multiply that across millions of users, and it's a major income stream. Balance transfer fees. Transferring debt from one card to another usually comes with a 3 to 5% fee. It sounds small, but again, with large balances, this becomes a significant sum. Foreign transaction fees. Traveling abroad, many cards charge 1 to 3% on each international transaction, quietly profiting off your vacation. Fees are a critical part of the revenue model. Even if you're financially savvy, the odds are that at some point you've paid at least one of these. Merchant fees, the hidden costs you don't see. The third way major credit card companies make money is by charging merchants every time you swipe, tap, or insert your card. This is called the interchange fee, and it usually ranges from 1.5% to 3.5% of the transaction value. Let's say you buy a $100 item using your credit card. The merchant may only get $97.50 of that money. The rest goes to the bank, the card network like Visa or MasterCard, and the processor. Here's the twist. While you as the buyer don't see this fee directly, it still affects you. To cover the cost of accepting credit cards, many businesses raise their prices for everyone, even cash users. So in a way, all consumers are subsidizing the cost of rewards and card usage, whether they use credit cards or not. Rewards, the bait that keeps you hooked. Credit card rewards seem like a great deal. Cashback, airline miles, hotel points. In some cases, people earn hundreds or even thousands of dollars a year just by using credit cards for everyday spending. So how do rewards fit into this money-making machine? It's simple. Rewards are a marketing expense, a relatively small cost compared to the profit credit card companies make from interest and fees. Banks use rewards as bait to encourage more spending, deepen loyalty, and keep you using the card. In fact, rewards programs often encourage people to spend more than they normally would. If you're chasing points or trying to hit a minimum spend for a sign-up bonus, you might rationalize purchases that you otherwise wouldn't have made. Credit card issuers know this. That's why they're willing to give you 2% back, because they're confident they'll get more than that from you or from the merchants you buy from. Interestingly, studies show that rewards are largely funded by the interest and fees paid by less disciplined cardholders. In a sense, people who carry debt are subsidizing the rewards of those who don't. So should you use a credit card? Absolutely, but wisely. But only if you pay off your entire balance every month, avoid annual fees unless you're getting more value than you're paying, steer clear of interest-bearing balances, and resist spending just to earn points. If used responsibly, credit cards can benefit you, but never forget the system is built to profit off those who don't use them wisely. Thanks for watching.